Hi there, my name is Tom Francis and I'm an accountant working with Accountant Online. We are Ireland's leading online accountancy practice. We provide a range of services and advice to our clients based in Ireland and the UK, and we provide ongoing support and advice to our clients throughout their business journey. Today I'll be talking to you about the options you have for paying yourself as a director of an Irish limited company. This is a question we get asked quite often, and there are a few options available. Directors generally have three options to pay themselves. They can choose one of these options or a mixture of the three. The first option is a salary with a pension at a later stage. A salary is a fixed regular payment to a director. So for example, you could pay yourself once a month. Important to note that a shareholder cannot take a salary unless they're also employed by the company. So for example, they would be employed as a director. The second option is dividends. A dividend is a payment a company makes to its shareholders from its after-tax profits. A director cannot take a dividend unless they're also a shareholder in the business. There is a third option where you don't have to take any kind of payment from your company, because as a director of a company, you're not obliged to pay yourself a salary or a dividend. And this might suit startups in their early stages, if they don't have the regular cash flow available to pay the directors in the first 2 years of business. Before you pay yourself a salary, you have to first know what kind of director you are. There are two types. The first type is a proprietary director, also known as a controlling director, and these directors own more than 15% of the share capital of a company. The second type is a non-proprietary director, or non-controlling director, who own less than 15% of the share capital of a company. And generally a director is treated like a company employee, and their salary is treated the same way. It's taxed at source under the PAYE system, and these taxes consist of income tax, universal social charge and PRSI. However, there can be differences in the tax treatment of proprietary directors and non-proprietary directors. Both types will generally avail of the same amount of tax credits, but proprietary directors will be in a different PRSI class than non-proprietary directors. As a director, you have an option to pay yourself weekly, fortnightly or monthly. If you want to pay yourself less often than that, so for example every 2 or 3 months, you would still need to run payroll every month. You just have to submit nil payroll for the months you don't want to take a salary. It is important to file payroll every month because revenue can charge penalties and fines for non-compliance. A non-Irish resident director can receive a salary if they're a director of an Irish company. However, you will need to pay Irish tax on income from the directorship, regardless of your tax residency or where you carry out your duties. But if you have to pay tax in Ireland and your country of residence, you might be entitled to claim tax relief in your country of residence. This only applies if your country of residence has a double taxation agreement with Ireland. A PAYE exclusion order is an instruction from Revenue to an employer not to deduct any taxes on an employee's income. You may need an exclusion order if one of your directors or employees is going to work for your company outside of Ireland. You can apply for this if you're an Irish employer, your employee carries out all work duties abroad, and your employee will be non-resident in Ireland for tax purposes during the tax year. We often get asked by directors about filing tax returns. If you're a proprietary director who holds more than 15% of the shares of a company, you will have to file an Irish income tax return every year, even if all your income has been taxed at source under the PAYE system. You'll also need to file a director's return every year, even if you decide not to take money from the company. In this case, you'll have to file a nil return. On the other hand, if you're a non-proprietary director, you won't usually have to submit an income tax return. Yes, a director can contribute to a pension, and there are two types of contributions you can make. The first type is employer contributions, which are contributions from the company on your behalf. When a company pays contributions into a director's personal pension fund, they're entitled to record this as an expense, which means they can save on the corporation tax on any contributions. A director also doesn't personally pay tax on this, making pension one of the most tax efficient ways to pay a director. Directors can also make personal contributions to their pension and receive tax relief on them. This relief is normally claimed at the end of the tax year on the director's income tax return. The amount of relief you can claim depends on your age and salary. Even if your company pays pension contributions on your behalf, you can still make personal contributions. This depends on how much tax you want to save, how many pension contributions you want to make, and how much cash you have available. We get asked this question quite a lot. Dividends are a payment from after-tax profits of a company to its shareholders. Dividends are not a tax-deductible expense for a company because they are paid out of your company profits after tax. On the other hand, salaries paid to directors are tax-deductible. Only companies which make a profit can pay dividends. If your company is making a loss, it can't pay a dividend unless it has distributable reserves. These are effectively retained profits. The next question people often ask is how the dividend they receive would be taxed. If you're a shareholder and tax resident in Ireland, the company will deduct dividend withholding tax at the current rate from the gross dividend payments and pay it to revenue. You will receive the net dividend and get a credit for dividend withholding tax deducted against your personal income tax liability. Please be aware though that if you're a non-proprietary director taking a dividend from the company, you may also need to submit a personal income tax return. If you're a shareholder living outside of Ireland, you won't usually have to pay dividend withholding tax if you can prove you're a tax resident of another country. You should report your income, including dividend income, in your country of residence and pay tax on it there. This will depend on your personal circumstances, such as where you're living, but it will also depend on your company circumstances, such as is the company profitable or not. Remember, if you're paid by salary, the company will get a corporation tax deduction for director salaries, and all taxes are deducted at source, which means you won't have any personal tax liabilities. If you're paid by dividends, on the other hand, your company will not get a corporation tax deduction for dividends paid. And it's important to note that you should always consider how dividends are taxed in your country of residence. For example, if you're a non-resident director, you may not have to pay dividend withholding tax or income tax in Ireland. Please note that the information in this video is intended as a guide only. You should always seek professional advice from a qualified accountant. These are some of the questions we get asked about paying yourself as a director of an Irish company. If you would like some more personalised advice from our accountants, please get in touch with our client services team here at Accountant Online. Thanks for watching.